18% ownership stake plus 1 board seat. Is that fair value or is that equity method? If you just said fair value because 18 is less than 20, you picked wrong. Bar loves this topic and they love that trick, and it costs people points on every single testing window. Let's fix it in 7 minutes. The rule you already know, under 20%, that's fair value. 20 to 50, that's equity. Everything above 50, consolidated. You memorized it. Your review course drilled it into your head. It's probably at the start of whatever you use to take notes in an Excel sheet somewhere, the fair value, equity, and consolidation percentages. But here's the problem. That's not a rule. It's a presumption, a starting point. And far right's question specifically for the people who treat it like a rule. The percentage is just where you start. The influence words are where you finish. And here they are. This is what you scan the stem for. A board seat, participation in policy decisions, that's like budgets, dividends, operations, material transactions between the two companies, swapping management personnel. The CFO works at one place and then works at the other at the same time. And then technology dependency. If any one of these shows up in the stem, the percentage stops mattering. 18%, it doesn't matter. 18% with a board seat is still equity method, not fair value. And it works the other direction too. If you get silence on all 5 of these at 18%, then that means fair value. And at the top end of the spectrum, majority voting control means consolidate. Full stop. No vibes about it. And one more thing before we start, because this is why the sort matters before you touch any math. Classification decides where the numbers go. If it's fair value, it hits net income. If it's equity method, it picks up your share of the income and ignores what the stock did. If it's consolidation, it puts their entire balance sheet onto yours. On the tells page, this is tell number 11, placement kill. One classification sentence kills half the options before you compute anything. Watch it happen 3 times. Okay, first question. On January 2, year 1, Alder purchased 1,000 shares of publicly traded company for 30 per share, passive investment. Alder owns 3% of the investee, has no significant influence, and the shares have a readily determinable fair value. At year 1, or the end of year 1, the share's fair value is 34 per share. Assume that the investment is not consolidated. The equity method does not apply, and no special measurement alternative applies. Now look at the options and see what they're where they differ, what they're fighting about. A, report the investment 34K, recognize 4,000 gain in net income. B, 34,000, recognize 4,000 in OCI. C, 30,000 and defer the 4,000 gain until the shares are sold. And D, report 30K unless there is an impairment, because the measurement alternative applies to passive equity investments. Okay, so we have an equity security with a readily determinable fair value. And that gain has to run through net income because we're at 3%. So the answer is definitely A, net income. You can cross off OCI. You can cross off deferring the gain. This question was all about placement. Check. Yes. And if you pick B, I get it. I know why. You're remembering that available for sale rules, but those apply only to debt securities, not stock. That's the bait. Next question. Read the question first. Under U.S. GAAP, which factors should govern whether Pine applies the equity method rather than ASC 321 fair value through net income accounting? Okay. Read the options as well. Shares are exchange traded, therefore measured at fair value. That doesn't seem right. B, Pine's ownership percentage, 18%, is below the 20% presumption threshold for significant influence. Interesting. B's okay. C, whether Pine lacks voting control of Spruce, i.e. consolidation rather than significant influence, governs ASC 321 applicably. Maybe. I don't know what C's even saying. D, whether Pine can exercise significant influence over Spruce's operating and financial policies, considering all relevant facts and circumstances. Okay. Now read it. They're going to give us someone owns some percentage of another company and then some random facts about it. Then we got to pick which method. Pine acquired 18% of Spruce's outstanding common stock. The shares are exchange traded. Pine has the contractual right to appoint one of Spruce's 7 directors, regularly participates in approving Spruce's annual operating budget. You remember that? They've got influence over the budget and dividend policy. Okay. And has material recurring transactions with. Okay, so these guys got a lot of influence over Spruce, despite only having 18% stake in them. That leads me to believe the answer is the trap is that, so you see 18%, you think fair value through net income, but with the significant influence, with all those things, the dividend policy, the budgets, the can appoint one director, it's all leading me to think that the answer is D, whether Pine can exercise significant influence over the operating and financial policies, considering all relevant facts and circumstances. Yeah, it's D. And notice option B, that's they have 18%, that's less than 20%. I mean, your flashcard will tell you, okay, well, if it's 18%, then it's fair value through net income. That's the question writer quoting back to you your own incorrect flashcard. FAR does that on purpose, or the exam writers for FAR do that on purpose. The distractor is built from the rule you memorized, which is exactly why the rule alone isn't enough. Remember, the percentage is a presumption. All the facts in this case just rebuted it. Okay, next question. Read the actual question at the end. For this, assume investment falls with ASC 323 if significant. When, if at all, should Alder begin applying the equity method to its investment? And the options are at the end of year 1, B, only when Alder's ownership later reaches 20% or more, because the equity method is not used below that level. We've spent this whole video saying the exact opposite. The equity method can definitely be used even if you're not above 20%. Cross off B right now. C, July 1, year 1, because the facts indicate significant influence exists at acquisition date. I'm guessing the acquisition date in this question is July 1, year 1. And D, only if Alder later obtains control of Birch, because participation in policy decisions without control is insufficient. No, they're tricking you here. The control, they're trying to conflate control with significant influence. But let's read the actual question. I don't think it's D, but let's read the actual question and see where we're going here. On July 1, year 1, Alder purchased 18% of the voting common stock of Birch. Alder also obtained the right to appoint one of Birch's 5 directors and began participating in Birch's operating and financing policy decisions. No agreements restrict Alder's ability to exercise these rights, and Alder does not control Birch. Does not control, so it's definitely not consolidation. Okay, so they're asking... it's definitely equity method. Like, that's what they're reporting, but the question is, when do they start applying the equity method? And we've already crossed off B and D. When they reach 20% or more, cross it off. And D, that's consolidation. That's not applicable. So their 2 options are at year end of year 1 or on acquisition date of year 1. That's July 1. And according to the facts of the case, they had significant influence right at acquisition date. You don't have to wait for them to actually exercise the significant influence. Like if they were doing a budget, most prepare their budgets in the Q4 for the following January, and that's when presumably this company would have some influence over the actual operating the budgets, preparing the budgets. But they had the influence right at acquisition, so it doesn't matter when they actually used the influence. So cross off A, you're only left with C. Yes. So that's it. Let's finish and check the score. Yeah, we got 3 out of 3. There's 2 doors I'm leaving closed on purpose. So there is a fair value option you can elect at acquisition. And if the stem says they elected it, then that election wins. It's pretty straightforward. And the debt securities held to maturity and available for sale, those are completely different trees with different placement rules. That's a different video. We've already recorded it. Go check it out in the channel. Don't blend the two in your head. So here's the 5-second sort that I'll leave you with. Say it before every investment question. Percentage is the presumption. Influence words override. Control consolidates. That one sentence, said in your head before you look at the options, kills half of them on contact. And that's the whole method. Reps until it's automatic. So go do some reps. There's a free 20-question practice exam over at chatcpa.io/exam. No sign up required. Go drill some MCQs.